So today's webinar is Unlock the Power of 1031 Exchanges, Discovering the Impressive Tax Benefits for Real Estate Investors. And my company is Magnify Real Estate. Jonathan is with us, and he is with Exchange Solutions. So we'll get through our bios here. Magnify Real Estate is a company that I founded with my brothers in 2019. We're a real estate investing and brokerage company, and we help clients grow their portfolio and increase cash flow. We have a really awesome tech platform that we just launched this week. So check out our website, magnifyequity.com. We are broker market leaders in the Bay Area. We've sold over $500 million of real estate. And in 2021 alone, we sold over 100 million. We have a personal portfolio that we built from scratch, and it's now over 80 units in the Bay Area. We do multiple 1031 exchanges a year, as Jonathan can attest, because he is our sole exchange accommodator, and that's why we asked Jonathan to join us in this webinar. Myself, I'm the Chief Investment Officer and co-founder, and I help buyers and sellers with investment properties in the Bay Area. I had a background at publicly traded companies, notably Marcus & Millichap and Colliers International, and decided to start our own company to focus on long-term client relationships and a family-first perspective. So we're not transactional. We look at long-term relationships, and that's really important to our company. I'll hand it over to Jonathan to speak a little bit about his background. I think you're unmuted, my friend. Let me unmute you.
There we go.
There we go.
Yep, thank you, Eric, and thank you for having me. Good afternoon, everyone. I'm Jonathan Bothman. I'm with Exchange Solutions. We are a local independent 1031 accommodator, and we've been in business for close to 30 years now. And I myself have been with the firm for close to 20 years now, accommodating exchanges all over the United States. We do both residential and commercial investment properties, regardless of size. And again, regardless of what state it's in, as long as it's within the US, we can accommodate.
Awesome. Chris Cave had a last minute schedule conflict that came up. He is a real estate attorney and 1031 exchange lawyer, and he focuses on transactions, dispositions, acquisitions, financing, development, and leasing. He will be available after this event to set up one-on-one time with, as will Jonathan. So we will be able to ask him our questions one-on-one. So what we're going to cover today is 10 things. The first is an introduction to the power of 1031 exchanges. We have a pretty wide spectrum of people here today. So we have some people that are in California or out of California. We have some people that are in an exchange or considering an exchange. So we're going to start with kind of high-level overview, and then we're going to get really specific and advanced. So we'll start with the power of 1031s. What is it? The different types of exchanges, the key steps. And then we'll get into more advanced things like the challenges, the risks and benefits, the do's and don'ts, various exchange options. And we'll end with a couple of our successful client exchanges and my own exchanges and how we can help. Now, remember that after this webinar is over, you'll be receiving a free gift. So please stay tuned to the very end. 1031 exchange overview is pretty simple. It's a tax deferral tool that real estate investors can use to build wealth, save on taxes, and expand their portfolios. It's something that I've used personally, and I'm intimately familiar with how it can grow your own portfolio. Instead of just sitting on one property over decades, you can actually amass a huge portfolio and defer the gains. It's applicable to basically any investor that wants to trade up, as we say, or use an existing property and buy something else. So there's really 4 steps, and I'll move quickly through this because part of this information will be included in the gift. You have a decision to sell, you actually sell the property, you find a replacement, and then you close on the replacement property. And there are details to each of these steps that we're going to get into, but I'd like to start with an overview of the various types of exchanges, because some people that have even done exchanges are not familiar with the various types. So I'll invite Jonathan to speak about the 4 different types of exchanges.
Thank you. Yes, so the first type of exchange is, referred to as a two-party simultaneous exchange, or often called a two-party swap. And that type of exchange has actually been around since about the early 1920s. And it was a provision, obviously, back then used a lot by farmers that would, trade livestock, or they would trade, land, farming land. And to this day, we do still see that two-party swap on occasion. Although when the Treasury regulations came out for the second type of exchange, delayed exchanges, which was around, the early 80s, that's when we began to see more of the delayed format, meaning you didn't have to swap properties simultaneously with another party. You could sell your property, and then you were given a period of a reinvestment period of time where you could go out, search for a new property, buy from a different party, as opposed to just swapping with somebody right then and there. So delayed exchanges, again, are definitely the most common type of exchange now that we see now. And then in 2000, the IRS came out with a revenue procedure for reverse exchanges, which allows investors to actually purchase their new property first, and then they have 180 days to sell their current property. So the name is just as it sounds: reverse, buy the new one first, then sell your current property. Along those lines, there's also a construction/improvement exchange, which can be incorporated into either your delayed exchange or into a reverse exchange. So just a high level overview on the improvement ones. You find a property maybe distressed or fixer upper, you need to use exchange funds to do those improvements to the property. And when structured appropriately, those funds can be used to do the improvements without having a tax liability on those funds. So those are the four types of exchanges. Again, just a simple two-party swap. You swap properties with another party. The delayed exchange, where you're given a reinvestment window of 180 days. The reverse exchange, buy the new property first, sell your current one. And then the construction/improvement exchange, where you're able to utilize the exchange funds to do improvements to a property that you purchase in the exchange.
Awesome. Thank you for that overview. So again, we'll have opportunities in the end for questions, but we want to start with exposing you to a lot of information. I wasn't even aware of the construction or improvement exchange until a couple of years ago when Jonathan educated me. So that's part of why we're taking this opportunity to share that information with the market. There are a number of key steps to the exchange process. The first is to assess the suitability, determine if this fits your goals, your lifestyle goals, your estate planning goals. And the second is to plan your transition. So you really want to work with qualified intermediaries like Jonathan at Exchange Solutions, tax attorneys like CPAs, real estate attorneys like Chris Cave, so that you make sure you're looking at all the pieces of the puzzle and you feel completely confident in taking that next step. That would tie beautifully in with seeking professional guidance. The fourth would be to initiate the sale itself. And so this would be hiring a broker like our own company to help you with the process of selling your property. The fifth would be to exchange a qualified intermediary. And there's a key component in time. So Jonathan, could you speak to when you actually want to engage the qualified intermediary?
Absolutely. So one of the most important things about exchanges and what you should know up front is that it's not simply a rollover provision. You can't just sell the property, capture the funds into your own bank account, and then reinvest it within the allotted time. The IRS requires that you use a qualified intermediary, or an accommodator is another word for it, to facilitate the exchange of properties and effectively turn it into a trade or swap of properties, as opposed to you just simply selling and buying. So the way that's done, you need to engage the services of an intermediary prior to escrow closing. That's key. Now, on our end, it doesn't take more than maybe half a day or a day tops to get an exchange set up in place. So as long as escrow hasn't closed, you still have time to get the exchange set up. So ideally, after you get a property under contract and in escrow, that would be an appropriate time to engage the services of an accommodator such as myself. We will contact your escrow officer, coordinate directly with them, draw up all the necessary paperwork to turn this into a trade of properties. And that way, when the escrow closes, we'll be able to capture those exchange proceeds into a trust account and hold those safely until you found a suitable replacement property to reinvest them into.
Perfect. And then can you speak to the timeline in step 6, identifying replacement property?
Absolutely. So your clock is going to start ticking once you close escrow on the sale. It's not when you get it under contract. It's not when you list it. It's when escrow closes. When escrow closes, there's 2 deadlines to worry about. Number 1 is the 45-day identification deadline. By day 45, and we're talking about calendar days, not business days. So by day 45, you need to submit a list in writing of potential replacement properties. Now, you don't have to be in contract on anything. If you are, that's fine. Or you could even close something within the first 45 days. But in terms of identifying, on day 45, you take a piece of paper, you write down the prospective properties you're looking at, you sign and date it, and you deliver that to your exchange accommodator. Now, the key is that you must buy in the exchange one of the properties that you identified during that 45-day period. So when you submit a list on day 45, you will be committed to buying one of those properties. And unfortunately, if you're unable to buy any of those properties, then you'll have a failed exchange. But as long as you're still within the 45-day period, you can always change your designations. You can select new properties. It's just once you hit midnight on day 45, that final list that you submitted, you will be limited to acquiring one of those properties.
Awesome. Closing on the replacement property is what Jonathan was just speaking about. It has to happen within 180 days of when you sell your what we call the disposition or the down leg property. And lastly, you want to make sure to consult with real estate attorneys and tax advisors throughout the process so that all your questions are answered. So now we're going to go through some of the benefits of 1031 exchanges. I'm not going to go into each of them, but I'm just going to highlight some of my favorites. Definitely the first and foremost would be the deferral of taxes. And that ties in with item number 5, purchasing power. Instead of paying taxes and reinvesting what's left, you get to use all of the money. So in some ways, you're getting an interest-free loan from the government, and you can buy a larger property because of that. A couple other things that I really like as well for our clients would be things like estate planning and management relief. So we'll get into what types of properties you can buy in a trade or in an exchange, but you can oftentimes simplify management or focus on passive income or dedicate certain properties to be for certain heirs. And that works beautifully with estate planning.
Yeah. And Eric, if I could just chime in real quick.
Please.
Another benefit of doing an exchange can be increased cash flow. And what I mean by that is a lot of times, maybe you own an investment property that's just a piece of raw land and you're getting no income off that. You can't depreciate that. So instead, you could look at exchanging that into something, say, like a commercial building where you can generate some cash flow, where you can generate some depreciation. So that's something else to keep in mind too, is that you can exchange out of non-depreciable assets such as raw land and get it into a piece of property that you can take those depreciation benefits and also get some cash flow.
Yeah, excellent point. Now, there are some risks with 1031 exchanges, and so we want to highlight some of these risks as well. A couple of them, like number 1, property identification challenges. You have to identify and close within 180 days. I've had clients say, you know, it's the 46th day. Can I identify? No. It's the 181st day. Can I still close on my property? No. So there are some strict timelines here. The second would be qualified intermediary risks. So you have to engage a qualified intermediary that is reputable, that you trust. We screened a lot of intermediaries before deciding to use Exchange Solutions in Jonathan Bauman's firm. And part of it is because there are a lot of exchanges out there or exchange accommodators out there, and they are holding your funds. So you have to make sure that this is a company that you trust, that has a long-standing reputation. I would not use a company that just opened up last night to place your, you know, in many cases, hundreds of thousands or millions of dollars or even tens of millions of dollars in their hands. I personally use Jonathan for all of my own 1031 exchanges, and we've done almost a dozen at this point. So I can vouch for Jonathan, and it's really important to choose one that you've vetted. The third would be market fluctuations. So, right now we're in a turbulent market, and it is possible that you're selling in, a peak and buying in a falling market, or you're selling in a low market and buying in a rising market. Those market fluctuations can be factors in your trade. But again, we're keeping it to a relatively short window, at most 180 days or 6 months to close, 45 days to identify. So there is some risk there, but it is limited because of the time that you have to do the transaction. The fourth here is something that we get questions on a lot: inability to access cash. So you have to generally use the full proceeds from your sale and reinvest them in the trade property. Now, there are some creative ways that I wanted to ask Jonathan about. Jonathan, are there ways that if a client wants to tap into a little bit of the cash that they could do that?
Absolutely. So the nice thing with Section 1031 is that it's not all or nothing when it comes to tax deferral. So you can definitely have a partially deferred exchange where perhaps you put some cash in your pocket. Yes, that will be subject to tax, but you are able to shelter the gain on the rest of your tax liability by doing an exchange. The key is that if you want to put some cash in your pocket, it can only be done at basically one of two times. You can take cash at the close of escrow on the sale of your relinquished property, put that cash in your pocket, have the rest of the cash come into the exchange account, or you can access cash at the end of the exchange after you've acquired all of your replacement property. So if you have remaining cash at the end of the exchange, it does not blow the exchange, just whatever cash is left over will be subject to tax, and you can receive it at that time. The only thing you can't do, however, is access that cash mid-exchange. So once the escrow closes and we capture the funds into the trust account, then the only thing you could do with those funds are use them to acquire a replacement property. You can't call me a week or two into it and say, hey, I could use some cash. I want to go buy this or that. Can you send me some money? Unfortunately, no, that will invalidate the entire exchange. So just know, yes, you can take cash. It does not invalidate the entire exchange. Just plan ahead. Either take that cash at the beginning, up front at the close of escrow, or take it at the end of the exchange.
Excellent. This speaks as well, kind of the same point, boot tax liability. So, if you do take some cash, that's considered boot, and that portion would be taxable. And Jonathan just spoke to the timing of when you could do that.
Yeah, and additionally, one other way you could also access cash is by once the exchange is completed and it's quote unquote old and cold, you could perhaps look at refinancing the acquisition property, pulling out some funds on the back end once the exchange is over and done with, and accessing cash in that fashion.
That's a great point. That's a great point. We've seen clients before that maybe they own the property, it's all paid off, they own it all cash, and they'll trade into a property all cash, and then simultaneously start a refinance so that maybe they close the sale and they close the refinance 30 days later, and that's completely okay in terms of a ability to access cash and qualifies for all the 1031 exchange laws.
Correct.
And that refinance is tax-free, right? Refinance
Correct.
Proceeds are tax-free.
Exactly.
Can you speak, Jonathan, to the transaction costs? Maybe touch on the 4 different types of trades and how much those transaction costs are at your firm?
Yeah, absolutely. So first, in terms of transactional costs on the closing itself, it is important to know that all costs of sale, commissions, title and escrow charges, transfer taxes, accommodator fees, those can all be taken off the top, and you don't need to worry about reinvesting them. So just a basic example, say you're selling something for 1.1 million and there's 100,000 in closing costs. Well, you don't need to replace the full 1.1. You can just replace the net sales price of $1 million. So in terms of closing costs, transactional costs, take those off the top. Now, in terms of fees for the different types of exchanges, the fee structure is pretty straightforward with most accommodators for your standard two-party swap or the simple delayed exchanges. Those don't require any special, deeding requirements, anything like that. So on average, you can expect an accommodator to charge you anywhere from, $1,000 to $2,000 on average for that type of exchange. And generally, most accommodators do charge it as a flat fee as opposed to, charging hourly or anything like that. So on average, about $1,000 to $2,000 for that type of exchange. The reverse and the improvement exchanges are a bit more complicated and a bit more expensive, as they do have different requirements from the IRS that involve actually parking the property with what the IRS calls an exchange accommodation title holder. So essentially what that is a company set up by the exchange company. Generally, it's an LLC that will hold title to the property on your behalf while you're doing those improvements or while you're using the 180 days to sell your current property. So because of those additional steps, getting an LLC set up and the fees associated with that, generally reverse and improvement exchanges, depending on where the property is located and the value, they can range from anywhere from about $5,000 to $8,000. So they are a bit more of an expensive and complicated endeavor. However, they are very beneficial, particularly reverse exchanges, because with the reverse, you're able to own two properties at the same time. You've got your acquisition, which you closed on, and you still own your current property. So you're able to effectively keep your equity and capital working for you consistently, as opposed to the regular forward exchange where you sell it and we capture your funds, and we might be holding those funds for potentially 6 months. And obviously, while they're not invested in real estate, you're losing out on a big return on those. So although reverses are a bit more expensive, they can actually, in terms of overall cost, they can save you quite a bit.
Very good. Thank you. So now we'll talk about some do's and don'ts of 1031 exchanges, and then we'll get into some examples and questions. In terms of do's, do talk to, as we've iterated throughout this webinar, do talk to your CPA, your accountant, your attorneys, your real estate brokers, your financial planners, lenders, qualified intermediaries up front. Let them know that you're considering an exchange and invite them to give some feedback on what they might consider. Everybody has a little bit different perspective. Your lender may say, did you know you have a prepayment penalty on the loan of the current property you own? Your financial planner may say, that's a great idea. You've got so much built up equity that we could actually use this equity here and maybe take some boot, as Jonathan described, some cash and increase your cash reserves. Your broker may say the property is worth a lot more than you thought. And that's why we like to do valuations for clients twice a year, just like your stock portfolio. Stay on top of it, especially in a market like now where interest rates are going up fast and the values of properties are fluctuating a lot more than maybe they did in the last couple of years. So talk to various parties because they'll give you insight at each step of the way. Jonathan, could you speak to the 3 basic rules for a trade, for a 1031?
Yeah, absolutely. So the first thing that you should know when you're buying property and selling property in an exchange is making sure that it qualifies for exchange treatment. So the term the IRS uses is like kind. And what that refers to is the nature or character of the property, not the grade or quality. So nature or character meaning, is it an investment property? Is it an income producing property? Is it a property you use in a trade or business? So it doesn't matter if the property is improved, unimproved, residential, commercial, as long as it's something that you're using for investment purposes, income producing purposes, it will qualify. So you can absolutely go from something like we discussed earlier, maybe a piece of land, to a productive piece of real estate, maybe a rental home or a triple net property. Those absolutely qualify. In fact, it's almost easier to tell you what doesn't qualify because that list is very short. Primary home doesn't qualify. Second home doesn't qualify. Pretty much everything else is a go. So properties need to be like kind. Secondly, for full tax deferral, you want to make sure to do 2 things. You want to go across or up in value from the net sales price. So again, as we discussed, total sale price minus the closing costs. And secondly, you want to make sure that all of the cash that you net out of the sale gets reinvested into the new property. If you do those 2 things, you will have full tax deferral. So again, across or up in value, reinvest all of the net proceeds. So that kind of leads us to the third item in terms of debt. You say, well, what if there's debt on the property? Debt does need to be replaced. And obviously, most people will just replace debt with debt, of course. But it's also good to know that you can actually replace debt with cash from your pocket. So if you find a property that's great, but you're worried that it's going to go quick, you say, well, gosh, it'd be nice if we could make an all cash offer on it, but I got to replace my loan. Well, actually, if you're able to contribute cash from your pocket, that will replace that debt dollar for dollar. So you could potentially get an offer in, make it an all cash offer, more attractive to the seller, and satisfy your debt requirements in that way.
That's a great point that Jonathan brings up. We see this all the time with clients where maybe they've had the property for a long time and they only owe a small amount on it, $500,000, 100,000, and going out and getting a loan for $100,000 on the next property might be more cumbersome than they want to go through. So they can just add that cash to replace the debt. So we do actually see that commonly. Another thing that we say to do is do attempt to sell your property before buying the replacement property. Generally speaking, I would say, I'm curious what you think, Jonathan, about the percent, but in my experience, probably 95% of transactions are forward exchanges where someone sells a property and then buys one in the 45-day and 180-day timeline. I'm curious what you're seeing this year, even in terms of percentages. Jonathan.
Yeah, I would agree. I'd say that on average, we see the forward exchange probably anywhere from 90 to 95% of the time. And simply because, obviously it's easier for a lot of investors to buy a new property when they've got cash in hand from the one they sold, which, it can be challenging with reverses is obviously you're buying the new property first, but you don't have access to that equity that you have in the property you're going to be selling. But if you do get into a situation where you find a great property and you want to, take quick action, you haven't listed your current property yet, a reverse exchange might be a great fit for you, absolutely. But it is imperative that you have to have the reverse exchange set up prior to closing escrow on the purchase. You can't just simply purchase it, buy it in your name, and then sell your property and do an exchange and say, I'm fine, right? No, you need to have the accommodator involved. Again, we've got to set up that special EAT is the acronym, that exchange accommodation title holder. So it is imperative, regardless of what type of exchange you're doing, before you close escrow on any seller purchase, make sure you've got your qualified intermediary involved so they can get it set up appropriately.
Yep, excellent. Now we'll speak about a couple of don'ts. So no surprise, don't miss your deadlines. The 45-day, the 180-day. There's no turning in your exam late in this case. It's pretty hard and fast. Another don't is don't try to do an exchange without using a qualified intermediary. This is a term called constructive receipt of the funds. So you're not allowed to give the funds to a CPA or keep them in your own bank account and then consider it an exchange. Anything you'd add to that, Jonathan?
Yeah, correct. Anyone who has an agency relationship to you, they are disqualified from acting as your accommodator. You do need somebody that does not have that agent relationship with you. So the easiest, party to find that can do that would simply be a qualified intermediary, as that is their specific role, is to not have that type of relationship with you, act as that neutral third party. That way you avoid those constructive receipt issues and you don't have the funds go to an individual or a company that has that, agent relationship with you.
Another don't, and I can speak from painful experience, is do not dissolve partnerships or change the manner that you're holding title during the exchange. We'll speak to this in a little bit with challenges, but the short answer is however you hold title now, if you want to do a 1031 exchange now, generally needs to be the way that you hold title in the next property. Jonathan, can you speak to the timeline that if someone had, let's say, a property now and wanted to plan for a 1031 exchange next year or the following, could they make changes to their title?
Yeah, absolutely. And just to take a step back to add to what you were saying, it is obviously crucial that it's the same taxpayer from start to finish in an exchange, meaning the sale of the relinquished property and the acquisition of the replacement property need to be reported on the same tax return under the same tax ID used for that tax return. So that's very important to know. Same taxpayer from start to finish. So that can present some challenges, perhaps, if you're in a partnership with other people and ahead of time that, when we sell this property, everyone's going to want to go their own separate way, whether it's taking their share of the proceeds, cashing out, paying their taxes, or maybe doing their own exchange independent of what everyone else wants to do. So it is important to try and plan ahead as best as possible. If you think that's going to be a possibility, it is important to try and take that property out of the partnership as early on as you can. And ideally, you want that drop out of the partnership to be in a prior tax year. That way, there's a holding period established for each of those individual or entities that own their respective share in the property. That way, when they sell the property, they're each relinquishing a direct interest in the real estate, which will enable them to do what they want to do, whether it's an exchange or whether it's cash out. But you can't just simply have the partnership sell the property and then you say, okay, well, I'm going to take my share of the proceeds and do an exchange. Well, unfortunately, you actually didn't sell any real estate. The partnership did. And all you got was the sale of a partnership interest, which is specifically excluded from 1031 treatment. So definitely try and plan ahead as best as possible. At a minimum, you want the drop out of the partnership to happen prior to the property being listed for sale, ideally. But even better than that, you'd like it to happen in a previous tax year from when the sale occurs.
Perfect. Speaks to the value of engaging your advisors during the process.
Absolutely.
So, number of potential 1031 exchanges. As Jonathan said, it's almost easier to speak about what does not qualify. So primary homes, secondary homes, but everything from land to industrial. We get a lot of questions about DST, Delaware Statutory Trusts, or triple net, retail properties, apartments. These all qualify as types of exchanges. This slide I wanted to put in here. Chris Cave was going to speak to this as a real estate attorney, but I'll speak on it on his behalf. So there are some challenges with ownership structure, as Jonathan was just alluding to. When you have a community property, when two people own a property together, or if you own a property as your sole and separate property, not really any challenges with that structure, and you can 1031 exchange. Something that I do get questions about often from our clients is, if I, let's say Eric Katz, own a property, can I close in the name of my trust that I just established, a revocable living trust? And the answer is yes, right, Jonathan?
Correct, absolutely. So a revocable living trust is a disregarded or a pass-through entity for both tax and exchange purposes. So the assets of that trust are reported under your individual Social Security number. So absolutely, you can sell in your individual name. You can purchase your replacement property directly in the name of your revocable trust. That will still satisfy the same taxpayer requirement and won't jeopardize the exchange.
Cool. Now, the second item, tenancy in common, has pros and cons, or benefits and challenges. The benefit is that everybody, so tenancy in common, if you're not familiar, is, let's say Eric Katz and Jonathan Bachman own this property as tenants in common. So we each own, let's say, 50%. We can sell a property and go our separate directions, which is really valuable. However, you may need some additional paperwork, like a tenancy in common agreement, in place so that the tenancy in common is considered valid by the IRS. Is there anything, Jonathan, that you'd add in terms of tenancy in common challenges?
Yeah, and another thing to keep in mind with the TIC arrangement is when, let's say, you're going to buy a replacement property as a TIC, keep in mind that only the value of the interest you're buying is, can be included in the exchange. So you want to obviously make sure to balance your exchange. So for example, if there's a replacement property and the total value is $1 million and you're acquiring a 30% interest, well, your interest equates to an acquisition value of $300,000. So just make sure that the portion or the interest you're buying in the property is of a high enough value to balance your exchange.
Yep. The third is the limited liability company. And this is probably the most common entity that I see doing a 1031 exchange, but can also be the most challenging. And that's why we wanted to highlight it. So when you own shares, when you are a member in an LLC, you have to 1031 exchange with the other members of the LLC into the new property, because the new property needs to be held in the same manner of title that the old property was held. And in the examples, I'll show you a couple of properties that I myself sold because we were in an LLC and the partners wanted to go their separate ways. We were not tenancy in common. And so it created a lot of challenges and problems throughout the process. So limited liability companies can be difficult. And this is why I say talk to a real estate attorney in advance, because if you think there's a chance that in the future the partners may go their separate ways, you might want to structure it differently, like a tenancy in common instead of a limited liability company. Anything you'd add
Yeah,
to
and
that?
and just to touch on that a little bit further with the LLC, keep in mind that if it's a single member LLC, it will be treated the same as the revocable living trust in terms of it being a disregarded or pass through entity. So you could, again, sell a property, let's say in your individual name, and you could look at putting together a new LLC, single member LLC. That's the key. It needs to be a single member. And a husband and wife as community property LLC is also a single member LLC. You could use that LLC to acquire the new property, as again, the tax reporting is going to flow through down to you individually and your personal social security number. So that is another option for you, that you can look at acquiring the replacement property in a single member LLC without jeopardizing the exchange.
I'm glad you brought that up. That's a question we get often is, if I'm tenants in common, can I be LLCs as tenants in common? And the short answer is you could have single or multi-member LLCs that are all tenants in common with each other. And so that's a way to still achieve the liability protection that you get from an LLC, but maintain the ability to do a 1031 exchange. So you can have, instead of Eric and Jonathan as tenants in common, you can have Eric's sole member LLC and Jonathan's single member LLC as tenants in common. And those could then have the real estate protections, but exchange separately. Correct, Jonathan?
Correct. Absolutely. Exactly.
All right. So now we just want to wrap up by talking about a couple of our successful 1031 exchange deals and then open it up for question and answer. So here's a deal story. This was a client that was in California, living in Belmont, and owned a property in Campbell, about 45 minutes to an hour away. She wanted to sell her property on the bottom here in San Jose Campbell border and buy something closer to her house. She ultimately was able to sell 16 units and buy a 16 unit and a duplex. And, she could walk to the property. So she was very happy about this 1031 exchange. The highlight here is sometimes moving geographies is a reason to do a 1031 exchange. You might want to move properties closer to home or out of state. In the second deal story here, and by the way, Jonathan Baughman and his firm were the qualified intermediaries on all of these transactions. In the second deal story here, we had a client. Actually, this was my own investments. So we sold a property at 354 North 5th Street, which was an 8-unit property in San Jose, and we used the built-up equity to buy a 7-unit property in Santa Clara and an 11-unit property in San Jose. So we went from 8 units to 18 units. So we were able to more than double the number of units by utilizing that built-up equity in our property. Third deal story here was a client who sold an 8-unit building in Santa Clara and bought a 16-unit property in Campbell. So he doubled the number of units. And as you'll see on the next slide, he then took that 16-unit property and sold it and traded it into a 29-unit portfolio. So in the matter of 3 years, he went from a 4-unit property to an 8-unit property to a 16-unit property to a 29-unit property. And this, I think, really highlights the value of using your built-up equity and deferring the capital gains to grow your portfolio. I mean, how many of you have a 4-unit property and it's a little bit far-fetched or perplexing to imagine that you would own 29 units in 3 years, right? This is the power of a 1031 exchange or multiple 1031 exchanges. The fifth deal story here is about trading into a different asset class. So we had a client who sold an apartment building in San Jose and purchased a triple net building in San Jose. They were able to increase their net income by 33%. So the cash flow went up over $50,000 a year. And this deal story is similar, but out of state. So we had a client that sold an apartment building in Redwood City and then bought a Dollar General. Actually, sorry, not in this case, not out of state, but out of area. They bought a Dollar General in Angels Camp, and they were able to increase their return on equity by 33%, and their cash flow went up by $24,000 a year. Most notably, they also got rid of any management because a Dollar General is a single tenant asset. So they had no management responsibilities. The tenant pays the taxes, the insurance, the repairs and maintenance, and the owner just receives a check each month. So it eliminated their management headache. So this is pretty much the end of our webinar educational portion. There's a lot of ways that we can help. We can guide you through the exchange process. We can craft a personalized goal for you. We can help you with finding exclusive properties or off-market properties for sale that might fit your goals. We have done these ourselves, so we can help you navigate the ins and outs. We have connections to exchange accommodators and real estate attorneys that can help with answering your questions. And ultimately, we can help you with building your portfolio or achieving more cash flow or higher return on investment. So as I now open it up to question and answer, I'd like to just put on the screen the gift. So thank you to all of you for staying through this webinar. You can go to this link on the bottom here, magnify.deals/free 1031 ebook. I'll also put this in the chat so you can click on it. And oops, there we go. This is going to highlight a lot of what we talked about. It's a many-page booklet that you can read about. So I'll put that in the chat now.
Hey, Jonathan, I can see one question in the chat that I can relay to you, if you don't mind.
Oh, perfect. Yeah.
One question I was asked, is there a maximum amount of properties that you can identify? I believe they're referring to the ID sheet.
Yes. So there is a cap. So the first thing to know is that you can always list 3 properties no matter what. No questions asked, values don't matter. You're always allowed 3. It's when you want to identify 4 or more that the IRS does have a cap, and it's called the 200% rule. So you basically take the total sale price of what you sold, and 200% of that or 2 times that. So let's just take an example. Say you sold something for $1 million. 200% would be 2 million. So the IRS says you can list as many properties as you want, as long as the value of all of them combined does not exceed $2 million. So that 200% rule really only works for investors that are looking at identifying and acquiring potentially several smaller valued properties. So again, maybe you sell something for $1 million and your intention is to buy, maybe 3 replacement properties around 300 or 350. Okay, you may be able to list potentially 6 or 7 replacement properties before you hit that $2 million cap. But if you're kind of looking at doing a 1-for-1 exchange, selling one, buying one, then you are just going to be limited to identifying a maximum of 3. But again, 4 or more, 200% is the cap. Take the sales price, multiply by 2, and then the value of everything you identify cannot exceed that number.
Awesome. What other questions do we have from the audience? You can either unmute yourself or put it into the chat.
So if you sell a property that you own by yourself, are you then able to on the replacement property, if you had other investors or somebody that wanted to buy in on a replacement property, can they, as long as you're still on the title as you were with your first property?
Yeah, absolutely. As long as you're getting a direct interest in the real estate, be it a fractional one or otherwise, you can absolutely buy with partners. Just again, make sure it's like a tenancy in common format. You're going on title to X percentage, and make sure that the percentage that you're acquiring equates to a value high enough to balance your exchange, right? So if you sold $1 million asset, well, you need to get $1 million worth of real estate in return. So if you find a replacement property that's $3 million and a bunch of people want to buy it with you, no problem. Just make sure you're getting a 1/3 interest so that it equates to a value of $1 million so you can balance your exchange.
Does that answer your question, Brandon?
Yes, thank you. I appreciate it.
Awesome. A question that we had in the chat was, can you do an exchange if you held the property less than a year?
Potentially you can. So the most important thing is intent. When you have an exchange property, the intent needs to be to hold it for rental or investment purposes. And there is no required holding period. So there's no legislation that says you must hold the property for X period of time for it to qualify. Now, the general consensus amongst tax people is they'd like to see a year or more, but that doesn't mean something held for less than that won't qualify. It can potentially qualify. And examples we see of that are particularly when you've got an asset, like let's say you do an exchange, you buy a property and you get, you hold it for a few months and you get an unsolicited offer that's well above what you paid for it. Well, your intention was to hold it for, rental/investment purposes. And you, again, unsolicited, got this great offer that obviously you'd be a fool to turn down. So in an instance like that, that would still qualify for exchange treatment, even though the holding period was rather short. So again, it boils down to intent. Obviously, the longer the better. A year or more is ideal, but in certain circumstances and instances, a holding period of less than a year can absolutely still qualify. The main thing that you don't want to have with a short holding period is you don't want it to look like that property was held primarily for resale or for flipping. That type of property does not qualify for exchange treatment. So you can't buy a property, hold on to it for a few months, and then try and flip it for a profit and do another exchange. Unless, again, it was an unsolicited offer. But if that was your plan, we're going to flip it after a few months, then that won't qualify.
And a couple of ways that I can speak to that we've had clients ask us, what shows intent for holding the property versus intent for selling the property would be, as Jonathan said, unsolicited offer. So, if you are in a position where you need or want to sell the property, don't put it on MLS, don't put it on public websites, don't demonstrate that you're marketing the property for sale, because that's intent to sell. But if
Sure.
You have a real estate brokerage team that can help you get an off-market offer, an unsolicited offer, that looks very differently if it were to go to the case where you're actually justifying your intent.
Correct.
We had a question in the chat. Zoom is being recorded. Will you provide a replay? Absolutely. This replay will be made available. Our goal is to make it available within 24 hours of this call. So we will be emailing out the recording to this session. We encourage you as well. I mean, Jonathan, I call him, he can attest, I call him all the time with questions. And that's one thing that I really appreciate about Jonathan is that he's more than willing and available to answer your questions. I'll ask him about weird scenarios. I've done things where I had my personal residence and then I moved out and rented it for a couple years and was able to do a 1031 exchange and take the homeowner's exclusion of $250,000 in my case. So, there are complex things that would relate to your specific situation. And that's why we encourage you to use the link in the chat box below and book a time so that you can have a conversation with Jonathan and myself and get your specific questions answered.
Yeah, and that's a great point.
We'll also include Chris Cave in this discussion so that you have a real estate attorney that can be answering your questions as well. Go ahead, Jonathan.
Oh, yeah, I'm sorry to interrupt. Yeah, I was just going to say that's a great point. There may be a property that you may not think qualifies for exchange treatment, but actually does, or can be made to qualify with just a few easy steps. So to find out if that's going to work or not, like you said, it is very important. Give me a call. Like I said, I do not charge any type of consultation fees. Happy to talk to you free of charge. Give me a call, send me an email. Happy to review the situation and scenario with you, and we'll see if we can make it work.
Awesome. And if anybody is in a 1031, go ahead. I was just going to say, if anybody is in a 1031 exchange right now, please do reach out to us. We may have properties that you have not seen or that are off market that we can show you. And if you're considering an exchange, reach out to us. We can give you a complimentary evaluation and we can guide you along the way of what might increase the value of your property now. I think I heard someone asking a question. Was that Steve?
Yeah. Hey, how you doing?
Good.
How long does it take to set up a 1031 exchange?
Go ahead, Jonathan.
It does not take long at all. I mean, if you're in escrow already, we've had exchanges set up literally before in 15 minutes. We've gotten a call the day escrow was closing. They didn't even know about an exchange. And, they're sitting at the signing table and they say, I just found out about an exchange. I had no idea. Is it too late? No, it's not too late. We can have, we could still have it done and ready to go while you're sitting there at signing with the escrow officer. So again, as long as escrow hasn't closed, as long as you haven't touched that cash and put it in your account, we still have time.
Okay, that's great. That's great to know. I wasn't aware, that there was that much flexibility. The other question I had was relative to the reverse exchange. Can you just take 2 seconds real quickly and so the reverse exchange is where you're buying first and then
Yes.
come back and go ahead.
Yeah, exactly. Where the reverse exchange is where you actually buy the acquisition property first, and then you've got 180 days to sell your current property. But the big key with reverse exchange is that in general, they need to be all cash acquisitions because we need to park it with the exchange company as required by the IRS. So the challenge is, do you have the wherewithal? Do you have the funds to purchase that new property first? And then, of course, when you sell your current property, we can take those funds, give them back to you. You can replenish whatever sources you pulled from. But for a temporary period there, you are going to be out of pocket. So that's the big key. Do you have the resources to buy that new one first? If so, great. Go ahead and make an offer. Let's do a reverse on it. Give yourself 180 days to sell your current one. But coming up with the equity to buy it, that's going to be key.
Okay, that's good. Yeah, I appreciate that. Thanks so much for that clarity on that.
You're welcome. I'll just add to that something we've seen is that the cash needs to be cash at closing, or cash at close of escrow, as we call it. So we've helped clients actually take a line of credit on the personal residence and use that to buy the reverse exchange property, because it doesn't matter if the loan is on another property like your residence, as long as it appears as cash in the close of escrow.
Exactly.
Thank you.
If I may ask, what is the biggest lesson that you feel like you've learned from 1031 exchange?
Just in terms of maybe pitfalls that others have made, things to look out for, or benefit wise?
Pitfalls.
Pitfalls, yeah. I mean, some of the most common pitfalls are, number one, not meeting the deadlines, right? Particularly 180 days is a hard deadline. You have to have your replacement property closed by day 180, no ifs, ands, or buts. It's not good enough just to have the property under contract. It needs to be closed. And even if you close just one day late, you close on day 181, you say, oh, come on, it's just a day, no big deal. Well, in the IRS's eyes, they don't care. If you close late, it's late. Doesn't matter if it's a day or a year. So that's the biggest thing, making sure you get the property closed on time. And then the other big thing is, again, making sure that you're going across or up in value from the total net sales price. So a lot of times, again, for that example we were using, let's say it's a $1 million net sales price, but you have a loan on there for a few $100,000. So we only end up getting $700,000 or $800,000 cash. The common misconception is people say, oh, I only need to reinvest the cash, right? And they end up doing that and they buy something for, $800,000. And they're like, oh, great, I'm not going to have a tax liability. And then they file their return and their CPA says, oh, surprise, you've got a tax liability because you didn't buy enough property. You sold something for $1 million and you only bought for $800,000. So again, it is more than just reinvesting the cash. You need to make sure that you buy something that's equal or greater in total value, total net sales price value.
Yeah, one thing I'll add to that is that I've had situations with my own investment property and with clients where they're not sure if they're going to do a 1031 exchange or not. And so what I advise them to do is spend the $1,000 or $2,000, close as a 1031 exchange account, have the 45 days, the 180 days to look for a property. If at the end of that, you decide, you know what, I didn't find anything I like, I'm just going to effectively close the 1031 exchange account, receive all the funds back and pay the taxes, that's absolutely an option. But what I've had clients call me on is, hey, I closed escrow last week. I'm so excited about your 1031 exchange webinar. I want to do a trade. And I say, you've already taken receipt of the funds. You can't do that.
Yeah.
It's too late.
Yeah. And another good point too. So yeah, just like you said, that there's no penalties or interest for a failed exchange. So really, your only exposure is the fee that you'd pay to your accommodator. So it does buy you some time to, hopefully you find a great property, or if you simply just change your mind, okay, cancel it. We send you the funds, you pay your taxes like you were going to otherwise. But for particularly this time of year, it can be very beneficial to set up an exchange, because if it were to fail, so your property closes this tax year 2023. If the exchange fails and you receive the cash from us in 2024, you can use installment sale rules to pick up the tax liability on your 2024 return instead, because that's when you're actually receiving the cash. So it can give you a little bit more time to worry about that tax liability and report it on your 24 return instead of having to report it on your 23 return. So tax straddling benefits.
Excellent. Any other closing questions? Yep, I hear one.
I had a quick question. Can you
Yeah,
hear
go
me?
for it.
In terms of dropping title into tenants in common, I think you mentioned you have to straddle one tax year. Is that 12 months, or is that, in theory, drop it in December and then January, that's a separate tax year? Is it
Yeah,
truly 12 months or what's the rule there?
Yeah, I mean, ideally, in a perfect scenario, it would be more than one calendar year. That would be perfect. But at a minimum, yes, if you can get it on a prior tax year, so even if it's, December of the prior year, that's going to make it look longer than it really was because you're going to have some ownership reported on 2 different tax years of individual ownership, even if it's only for, 1 month out of the year. Right. But on the tax return, it makes it look longer. So yes, ideally, of course, a calendar year or more would be nice. But at a minimum, if it's, even late in the year so that it still is a prior tax year, that is still going to be very beneficial.
Great question. Any other questions before we close out? Brent?
Can you talk a little bit about converting rental property to personal use?
Absolutely. Yeah. So again, there is no required holding period. So there's no legislation that says you must rent it for X period of time before converting it to a different type of use. Again, 1 year is kind of the generally accepted time period. So let's say you do the exchange, you buy the property, you rent it for a year. After that, if you want to convert it to a different type of use, be it primary home, secondary home, vacation home, you could absolutely do that without having any tax ramifications. The conversion from investment to primary does not trigger any taxes. So again, no required period of time. Ideally, wait a minimum of 12 months. If you're very conservative, maybe you want to wait closer to 18 or 24 months. But a year or more, you'll be fine.
Thank you.
All right, well, I think that's all the questions on the table. Thank you to everybody that attended. We'll be sending out a recording of this webinar as well as an email with the booking links and the link to the 1031 exchange ebook. And we encourage you to take advantage of our expertise, book a time with us so that we can talk about your specific questions. And thank you to Jonathan for your expertise in this call and for sharing
for having me.
your valuable time with us.
Appreciate it. Thanks, everyone.
Take care.
All right. Have a good day.